Good evening, good evening. I hope you can hear me and welcome for a new year. It's year 2023 and I think many of you may just want to forget about year 2022, or maybe some of you have done much better in here, but I have to say even my longer term portfolio has suffered too. As a result of the heavily inclined towards the technology stock, but it's okay. That's why we are looking for year 2023 and we want to see what are the likelihood events in year 2023 that would help us in here. I really appreciate if you could share this video in your timeline, and let's take a look at what we have for you in our today live FB. Let's take a look. And so welcome tonight to the live Facebook of Martin T.F. Wong. As part of the co-founder of Trade VSA, we'd like to welcome you and thank you for sharing. For many of you who have joined us tonight, a very special topic in here, and we're going to take it from a very slow path with what we have learned from year 2022. And a few things I was also wrong about, I have to admit. First thing first was the Russian and Ukraine war, which I would think at least within 3 months pretty things will be settled down. But instead, right, what we do have a proxy war between the US and the Russian. And the likes of look of it, I think many of you would have agreed, right? Quote me on that. Is the persistent war is likely to continue even to 2024 as both Russians and Ukraine are sort of going through this what we call attrition war. Whoever will last to the end will survive in this war in here. Definitely we have seen Ukraine will continue to pound on in as much as the Russian Ukraine will continue beyond 2023. Where should we put the money? So all this will be much of what I will discuss tonight. And thank you again for joining us tonight in here for a very special topic. Don't forget to subscribe to our YouTube channel so you can watch this again, pretty much of it. Now tonight topic, where are we be putting your money 2023? I will take tonight as an approach to be more prudent, right? And this is not so much on the usual intraday or trading, but we are going to be talking about the longer term kind of stock, especially if you're a new beginner, you want to be taking more more presence in this. Some of the stocks I'll be talking in here. We will review very shortly in some of the market analysis for 2022. We will look at some of the best and worst stock for 2022, and also focus a lot more on the US market outlook and also the Fed policies in here, followed by the sector to watch out for year 2023. And then of course I'm going to showcase to you some what I think for at least for the first week using the Robie FA rating for some of those stocks that is currently right at the sweet spot, right at the stage 1 accumulation. And who knows, we will see again going towards the beyond the second half of 2020, will this stock move higher? Of course, I do take note that many of you, especially in year 2020, it is still going to be a year of moderation. Improving market sentiments in here, definitely the unlikely of a recession. Right now, Malaysia is still projecting somewhere between a 5.5 GDP growth. So we are not looking to recession, but on the back of our head, the inflation monster continue to be, and of course using the VSA 360 will definitely be an excellent tool for our FA. So tonight is definitely a focus on our FA in here. Now what's in store for year 2023? Much of it is going to be really focused on the US Fed policies, which we've always been talking about in here. Now, pretty much of Fed has always been very dovish, which means they are quite reluctant, having said that, but they were very slow in the year 2021 and year 22 to really raise interest rate to counter inflation. Remember the word they were talking about, transitory inflation, which means it will go away. But eventually it did not go away, and we saw inflation actually hit the high. You all remember when was it hit high again? Looking from the US perspective, it was in June 2022 when the market hit 9.1. At that time, everyone was shouting about, of course, few policies has been put in place, and one of them was really put a cap on the Russian war. And many of these are inflation induced by the war conflict between Ukraine and also Russia in here. And just now in the introduction, I did talk about the likelihood of this war continuing beyond 2024. It's the last person standing. Now, for those of you who are listening, who do you think will probably stand towards the end? Is it going to be Putin, or is it going to be Ukraine? Pencil those in there. I want to hear your comment in here. Definitely, I think in terms of social media and handling it much better, all of you would have agreed that President Zelensky has a better, and he was actually been an actor in it. You should check out the Netflix, one of the series that he played as a school teacher becoming a president, and right now he's a president going against one of the most hardliner, that is President Putin, and we want to see what the outline with it. Now, pretty much I can blame with it, all this growth that we are seeing being terminated as soon as the war broke out last year, February 24th, 2022, and coming to this February will be almost 1 year, right? Right now we can see the Russians is really trying to drag this out by firing a lot of drones. You can see this in here, and that's going to be a continuing escalation into food prices going up, fuel prices going up. Of course, all this does benefit countries like US, who does produce shale oil gases, and one of the producer for gas. Of course, EU and Europe, which is United Kingdom, all are pretty much in the recession because of the higher gas prices they are paying in here, and that's been really a fear of it, that this EU and also maybe parts of Germany and France will spread to many other ASEAN countries. So far it is as the ASEAN as well as the Asia, we are likely to escape this recession in here because of the robust economy they had, and we don't have a higher index regime. But of course, right at the bottom in here, now we all know just on December 19, presidency of China did a U-turn on the zero COVID policies. Many of you have seen as such that on the 8th of January officially they are reopening their borders, and you can see the influx of Chinese tourists coming in, and that's been a lot to say about the new variant COVID-19. Many of you are following this very closely, because the next day when you go out during Chinese New Year, you will go to a local shopping mall, you definitely see a lot of Chinese tourists in here. They may be good for the local tourism in here, but definitely we are fear for the new COVID-19 and whether the new vaccine that is in place can perhaps take control of this in here. So all those are what we call a small probability that might just put us back into the same lockdown that we have in year 2021 2022. All right, okay, so that's what's in store. Keep this in mind. Still pretty much the Fed controlling a lot of how the market it is, right? The recession, which is the fear that we are seeing due to the continuing war conflict, and right now even as China is reopening right now, which actually is a blessing for all, because we want to see the supply chain being pretty much filled up, but the COVID-19 flare-up is what we are likely to experience, whether or not. Now, when it comes to year 2022 yearly return, many of you may have seen this already, but definitely the KLCI is down. Every market is down, let's put it that way. The only best performing market was actually Singapore, which actually up 4%. But if you look closely in Singapore, why is it up 4%? It's because from October onwards, where they thought of raising interest rate, and remember, much of the SGX, Singapore STI, are heavily capitalized by the financials, and also a lot of those are what we call sensitive to the interest rate movement in the upper side. So when that came, they were one of the biggest 4%. Of course, on the US NASDAQ, we all know these are very strong, laden with technology. That's why we see the NASDAQ, which is minus 33% down. And pretty much like what I've said earlier on, I have to admit, my longer term portfolio was still inclined towards the technology stock, as I think at that time the Fed chairman will pivot back to a more delay interest rate and might not see the Dow Jones fall that much. But as you've seen, even the last week, we've been talking a lot about the December rally, but it didn't came. Instead, it was a Christmas bear. But keep in mind, usually when we see a Christmas bear, right, likelihood we're going to be seeing a lot of is the returning of a very bullish January month. Let's keep our finger crossed for that one. So Dow Jones is still down minus 8.8%, not as high as much as the technology because they still have a lot of this called sensitive, non-sensitive interest rate, which mean like the oil and gas, the financial, which we actually benefited from the raise of the interest rate as such that the technology actually fell. Many of the institutional and fund manager started to leave the technology. That's why we see a big fall from there and started to pile back up to the Dow Jones. On the S&P 500, we have a minus 19%, which is a good mixture of both of the value or traditional stock plus also the technology in here. So that's somewhere in between the 8% and 33%. That's why we have the minus 19.4%. Tell me, how has your portfolio, especially in the longer term, been, right? Because we are not trading from trading sense. Now, if you look at the seasonal monthly chart, this was the last update I think I've done with many of the members for the live FB. You can see the total return at that time when we see KLCI was minus 5.2%. This was almost 2 weeks in it, and I did mention the last 3 days we will see a market rally. Indeed, we had last 2 days we have the nice market rally as soon as the market opened on Tuesday. Then we have that 20-point pullback, and that's usually the case because people are not willing to pay up for the price, especially if you're on the last day, and that's why the market is down 20 points on the first day. Usually that's always been the case. If you look back, even year 2021, year 2020, they always do this kind of thing. But in short, you can see from here, in December month, we have the minus 1% in here, and lo and behold, it did close with a positive due to the last 2 days of rally that we have. Now, after the 7% down, right, usually the market recover back. We have the best October month, then we have the November, and then we have the December month. You can see from here, let me just show you here, December month, the October, and these three are pretty much the sort of bring back almost the minus 7% back to minus 3.6% down market that we've seen so far here, right? So all in all, market still looking pretty much the same as I've said for year 2023. If you go back to almost the last 6 years, our GDP is still growing as a Malaysia, which I'm going to go through some of the later slide in here, but you can see the yearly return has been dismayed, really less than 1% in here. So if you ask, if you want to invest in the longer term, sort of like a buy and hold strategy, right, that may not work very well for KLCI, but let me just share with you a strategy which I will talk about to some of those latest stocks with better ratings, at least with a 5 and a 6 rating of Smart Robie, that will put you in a much better position. Now, there are very small details in here. I hope you can see this. You can pinch out in here. This is from the Edge magazine as of 30th of December. I think some of you may have came through this, looking in just the large cap stocks. They have the large cap, the mid cap, but I just want to focus on the large cap in here because the smaller and the mid cap stock, depending where you are, if you are trading one of those penny stocks and caught a good one, you may end up with almost 100 or 200% if you intend to run it up in here. But I think for most cases, going by the average, you might just take a specific profit and then come back in again and go back in again. That's always been that kind of trading theme for 2022. But now looking at it from sort of a large cap stock ability to invest, you can see one of the best performing stocks is still AMB and StarBiz, which is actually consumer, plantation, and banking, and also oil. You can look from here. This is definitely an energy sector. You have the Petras Dagangan, and then you have the consumer, QL Resources, and then you have plantation followed by 2 banks, just for the top 5 in here. Of course, if you go back to the bottoms right here, you can see in here, Technology stock was one of the worst performer. You can see, as such as I said before, even in US, you're seeing that. So a lot of the things, excuse me, that we see in the US will also perforate back to our market in here. If your stock falls less than 5%, or gain 10% for the entire year, I have to admit that's been very, very good. The market has not been very so-called been very lenient to everybody. As I said before in here, year 2021 was much better if you have technology stocks, and those have certainly performed well. But for whatever that we are looking back for year 2022, that hasn't been the case. There is a complete rotation out. This is due to the sensitivity of the interest rate rise that we've been talking about, as well as the conflict that we continue to see, which push up food and also fuel prices up, and that's why some of the energy has done very well, and we see Petronas Dagang doing very well, 15 up. Now if you look at AMD, certainly for the longer term, those of you who invest, I highly recommend using the VSA plugin on the weekly basis. Okay, use the weekly chart for that matter. You can see in this case, when the market fell right way back until this was October 2021, you can see here, and where the market actually picks up was somewhere around here in 2021, somewhere this portion here. That's really a good entry, and you can actually run that market pretty much from where we were April to December in here. You could see we are already in the blue pentagon. Okay, so when the blue pentagon on the weekly chart, for the longer term, that's actually a good area to be looking at in here. All right, so another one is QL Resources. You could see the market was actually range bound in here, but did finally pick up sometime in April on that point when you see that green pentagon in here. So that could be a good entry point. So using the weekly chart for that one. So usually what we do say, if the market has sustainability for that trend to move on the weekly chart, then you would have this market picking up. And also, of course, the earnings has also picked up, and the QL has broken back to the $5.75 mark in here. It came down a bit to $4.50 in here, but of course we all know usually when the market reopening, we see even Genting right now is starting to move. Check out Genting too. So a lot of this so-called China team is coming back in here. I do think that the Genting is turning green pentagon, so that's something you want to check out on the shorter term for those of you who are trading for that one. Then one of the biggest fallout, of course, from that list is also, second one is Axiata. You can see again on the weekly chart when the red pentagon drops, that can also give you a clue for those longer terms. If you hold those longer term stocks which actually have ratings of 3, 4, 5 and 7 of the smart Robie, that is something that you want to think to take some action, maybe reduce it, and so you could see to avoid the big loss that we are seeing right in here. Okay, now if you look back in terms of the KLCI, this is definitely from the star, but I do will probably dispute this figure. If you look back, the red bar here are the equity return. No, with the exception of 2017 and 2020, most of it you actually don't really make money in the KLCI. Just again looking from the large cap stock. So it does tell you the strategy going forward for 2023. It's going to be on pretty much on the trading mode in here, which means you go in based on the green pentagon, you take a certain profit target level, probably maybe 8-10% in here, and you don't want to be overrunning to one and then come back in again. That will be the much better. But for tonight's scope is actually for those of you, especially beginner, want to know some sort of a base, especially for our members. We did teach them 2 portfolio strategy, what we call the barbell strategy, which is one is a longer term, another one is a shorter term in here. So shorter term being the one that is trading, the longer term is the one that you want to be holding some stocks, collecting dividend, and that's one of the focus in here, to have some of those highly rated. And you would see, even bearing in mind a lot of the smart Robie rating stock that I'll talk about will have very good ratings in here. Check it out in the VSA 360 under the MC portfolio. Now on this chart wise, what we are saying in here, next one is bond. Even in year 2021 and year 2022, if you have whole bond, you will lost money. One of them is because the interest rate move inverse with these bond prices in here. Okay, so if the interest rate were to go higher, bond prices have to come back down, and that's why you're losing money. So those of you who are looking into bond, just take note, once bond you start to drop interest rate, then you see bond prices going up in here. So that's why they are forecasting 2023 will be a year of improving bond yield, okay, improving bond returns in here, 6 to 8% in here. Of course, cash being cash, it does have the very small returns that we see so far. Now, if you have any question you want me to take a look, I'll be happy to pencil those in the segment there. I'm looking into it too. All right. Now let's move on to according to the big boys in US. Now, according to Goldman Sachs, for his year 2023, impact to the US and EU. So let me just summarize it for you in here. What they are also saying, right, with the growth really slowing down from 2022, right now we're seeing a lot of economy reopening. First thing on their mind right now is how to deal with the interest rate, which is induced by pretty much by the inflation, which is tied back to the Ukraine war, okay, the Russian-Ukraine war. Now we all know the Russian-Ukraine is not going to go away in 2023, nor maybe continue in 2024. So which means they have to use monetary policies to control the inflation. Definitely one of them will be tightening money supply. By tightening money supply, which means they are raising rates, so poor people would actually park their money on fixed deposit or in treasury use, and that would actually in terms reduce the money flow that you see in the market right here. So with that in mind, EU and UK is also pretty much in recession, as they're one of the biggest dependent on the cheap gas, oil and gas prices that are coming up, and now right now they really have to pay through their nose as sanctions is going on, that they have to tape down on the amount of using the energy sector, especially now winter is pretty cold in the UK, so they have to tape down. They have keep enough supply for this winter, but coming to next winter they do not know yet in there. All right, so that's why we are seeing the inflation has really pushed the economy to slow down, because people just don't have the money to spend on clothing, on those what we call cyclical like cars, clothing, holiday, right? Because they just have to pay for the heating bill, because winter is pretty cold in UK. You all know about that. All right. So the next point is that because to be frank with you, US is one of the shale gas producer and also largest gas seller. They sell the gas to the Europe, so they really benefited from the war itself and very likely to avoid the recession. So that's why you'll see a lot of the big oil and gas stocks in US like Chevron and Exxon. No, they have fell a bit more, but they have did well overall for the year 2022. So US is likely to avoid the recession in here. Of course, inflation going more likely after, we're going to talk about interest rate after this, to slow down, okay, inflation to slow down. Definitely we are waiting for the 12th of January 2023, which is another 8 days from here. We'll see that likelihood of the inflation figures that we all keep an eye for, because that inflation will drive how much the interest rate is going to go up or go down, or whether likely the US Fed chairman will do a pivot, which means rather than raising, they say, hey, maybe we want to slow down or we want to raise less in here. But definitely the target right now is 5 to 5.5% for the Fed interest rate raise. All right, so in another part is point number 6 is the long-term inflation is going to stay even as the war dissipate, and I don't think the war is going to dissipate, assuming we still have the war going on for 2023. Now keep in mind the Crimea War started back in 2012, which has almost been going on for 8 years. As long as they have money to fund the war, they will keep going for that one. And of course you all know that Ukraine is relying on President Biden, and President Biden with his US Congress will back up Ukraine as long as it takes, because as I said before, this is a proxy war between US and Russia, where US don't have to send their soldiers. So in a way, it's a low cost of fighting. All they got to do is send the weapons over in there. And guess what? Eventually, Ukraine still owe the US. And this is one of the ways you can see US using dirty jobs, dirty ways to fight their war. And we all know even US is not as angel, as looking at it. They are as cunning, as cruel, just like what we've seen in the Russian is. So don't get brainwashed by all this, okay? So right now, the Western country, especially in the EU, are no longer can depend on the cheap oil gas prices. They have to buy from the open market in here. The Saudis and the Americans will definitely benefit from it in here. All right. And then again, ECB, the European EU, will expect another interest rate hike in here. Now let's look at the schedule of the calendar for 2023 interest rate. So right now we are almost at 4% or 4.3% depending which chart you're looking at, which is in here, the interest rate hike. So at 4%, you all know the BLR in Malaysia. How much is it? Definitely more than 5%, right? BLR in Malaysia. Am I correct now? Let me know. Type it in there. What is the BLR at the bank? I haven't checked yet, okay? So again, there is another 50, 25, 25, 100, maybe 125 basis point, which means another 1.25 to coming, because 4%. Right now we need 1.25, so that will be 5.25 interest rate. Now all this interest rate is going to be really depending the schedule of it. It's going to depend on whatever coming out from the annual inflation rate, which is released every month, as I said, which is next we're going to look at. But very importantly, what we want to see here, if the inflation rate do drop fast more than what we think, then maybe we'll see a pivot. Then maybe they may raise slower interest rate. Then we'll see the market start to pivot, the breakdown. So we are at this junction, or what I call the slow burn, which I'm going to give you the definition in here. So if it goes on course, all the interest rate rise, right, in the first half of 2023, you see in here, we're going to have one, because we just have a 50 basis point raise in here. This was written sometime in November in here. So you're gonna 25, 25, 25. That's another 0.75 interest rate rise in here. So that is going to be in February, March, and May, which means all the interest rate has been moved to for the first half of the year. All right, first half of the year. So, and that's going to give you a better focus on the second half of 2023, which means, what does it mean? It means a lot of the technology stocks is going to be starting to move, right? That's what we are looking at, right? All the technology stocks, all those interest rate sensitive stocks, right? Because that's where demand, and also keep in mind the second half of the year is where you want to take more risk. So for the first half of this year in here, it's likely to stay defensive. All right, stay defensive. That's a strategy. You'll be stay defensive. Keep your bullet dry and look for some dividend stocks and take a bit in here, take small profits in here. And then the second half of 2023, all right, assuming we have a sell in May and go away, usually that's the case, which means May period we'll see the market bottom down. Of course, I will still be here with the live FB. Many of you will still continue to enjoy some of the information sharing, education material that we have in here that will be beneficial to you in here. So the focus is second half of the year, but May 2023 is a good time. You know what I'm going to say in here, even if you go away, right now until May, you may not miss a lot, having said that in here. So after seeing the schedule, and this is what I talk about, the slow burn Netflix. Now the slow burn Netflix is one of those movies, especially during the COVID. We have nothing much to do, so I watch a lot of Netflix movie, right? I'm sure many of you do that. And a lot of those mini series or episodes are what we call slow burn. And slow burn is it's one of the definition is that it take and you have to wait a long while for something action to happen. And that's what's happening right now. And the situation need to develop itself. It's like I wait for you, you wait for me before next action. So this is where US Fed chairman will have to see. Now, if the inflation fall faster than it is, then he may not want to raise interest rate, and you can see the market goes up. If the interest rate on these 12th of January, this coming 12th of January, only fall to 7.1 to 7%, then they may have to raise a 25 basis point. So a lot of people are doing a lot of forecasting. So it takes a long time, and you really have to be patient in here. So we have come out with Goldman Sachs, not me. Okay, Goldman Sachs come out with this schedule in here up to maybe May, where all the 75 basis point interest rate has been raised. So they are raising 25 basis point, another 25 basis point in here. So all bags going to be banked on the 12th. And do take note, the last 4 or 5 days, fuel prices has been coming down, but food prices is one of the concerns. Now food again has this increase of the inflation of the food prices were caused by the war in here. So that's not going to come down very soon because supply chain, fertilizers may not be available, and that's why we are seeing this really slow burn. And pretty much year 2022 has been a slow burn. After we saw the war, okay, we were waiting for the war to end within the first 3 months, maybe by May it will end. It didn't, then it goes on to spring, then autumn, and right now winter. They're still fighting, right? You have seen also the latest Russian-Ukraine war, where the Ukraine claimed a deadliest attack on the Russian barrack, where more than 63 or to up to 400 people were killed in here. And this is going to create a lot of vengeance, a lot of anger on the Russian side, and the Russian is definitely going to send more drones over, and that's why you see this slow burn, right? So call it a slow burn, remember, okay? All right, it's like a mini series, so you have to wait for it to develop in here before something take action. Now, according to UOB research in here, some of the 2023 forecast figure that many of you need to keep in mind, at least be aware of. One of them is the GDP growth of 4% in here, which is 2020 was good, 8.3. So that's why we are not going to go into recession. Current account is 2.5%. We are not producing enough, and that's why we have physical balance of minus 5.5%. Simply says that we are actually, and that's why the new Prime Minister, the 10th Prime Minister Anwar, has to come in and deal with the current situation, the higher food prices in here, slower employment in here, and also we call the talent outflow in here. There's a few things that I look at. Interest rate rise is currently the interest rate is at 3.25 in here, which is compared to US is 4.25, and that's what Malaysia playing catch up. But another 50 basis point is scheduled in the first quarter of 2023. So that is going to be a very challenging, very difficult for many of you who are property investor. Right now, you're already saying, wow, you're paying so much for the banks right now, right? With the interest rate hike, those of you who have property interest, right, you just have to tahan through. Another 50 basis point is likely to come over for that one. That's why making property something you do not want to touch on, maybe just second half of the year where we see interest rate drops, and then we'll see. Of course, inflation right now you're seeing at 2.8. That's simply the CPI figures, which make no sense in my opinion in here. The ringgit has definitely strengthened back, and this is again what I've talked about, correlated with the China reopening, and because China is one of our largest partner in here. And of course, you may argue too, we produce oil in here, and we produce many of the technology. Doesn't that account for our currency? The question is no. We are always tied to China in here. This correlation has not been depegged. So I don't know when will we depeg, which means we will run on its own, just like pretty much like what Singapore is. But right now, as it is before, I think with the strengthening of our ringgit, okay, strengthening of our ringgit in here, that would give incentive, okay, for foreign funds to come into Malaysia, which I will talk about it shortly. Foreign funds are slowly trickling over the last 3 days of the year, but the last 2 days it's a sort of left off. We can pick it up from the VSA 360 foreign funds flow in here. So average crude oil, first quarter is $90, second quarter is 90, and third quarter is 100, and fourth quarter 100. I don't think it's going to be possible to go up to this $100 in here going if there are talks about Russian and Ukraine war going to be towards Q4 2023, right? The kind of time frame in here. But again, these are just forecast. Now from a chart analysis in here, Our KLCI looking from it's not too bad, to be frank with you, it's not too bad. It is looking to go higher. Now you can see, right, we first tested in June, the 200 moving average, then we dip back down, we test again in the end August, then we test again after Anwar became the 10th Prime Minister, and then we tested on the last day. So these are very significant a milestone the market is testing in here. This was where, you know, they talk about the interest rate may slow down, and that's why the market tried to break. So the market has a lot of spring, you know, you know, the kind of spring really to push up in here. And of course, you will also know it is turning green pentagon in here, but the last 2 days is selling in here. So all those is going to be refocusing a lot on China reopening in here, and also the interest rate movement. Now interest rate is projected to move up, so I don't think many of this is going to be dropping that much, because interest rate goes up, that's really good for the banks eventually, and that will in turn turn to earnings. And don't forget, the large capitalization of our markets are actually heavily on the finance side in here. So 1, 2, 3, but it's very important that the market eventually break through this 200-day moving average that you see here, really at the 1490, just short of 1500 level in here. So right now the trend is still pushing upwards. The last time when we went down 11%, this one pulled back to 4%, and then we break through in here. But of course, if you look back in many of the beginning of the year, usually the market will just move sideways, retest back, but we have a lot of great support that we see around the 1460. That is what we call the Great Wall of China. And if the market can hold above the 1460, which it did, right, testing the futures 1446, which is down 70 hard points in here, market likely to rebound tomorrow. And it's also at the 40-day moving average. So see tonight, the Dow Jones should close back up, because the market's going to range bound, move up, move down, move up, move down, not really certain where to go from here. Now from the S&P 500 in here, of course S&P 500 consists of both technology as well as the value and traditional stocks in here, so it's going to have a good mix. Again, you can see also very similar, it tested 1 time, 2, 3 times, and then finally bounced back in here. And the KLCI also came back down. So right now it's building a nice base in here. Partly this is also Tesla to blame. Tesla, the CEO, Elon Musk, the Gale go and play all this Twitter stock. Then that's why Tesla falls some more, but the market is holding up in here. And Tesla is also one of the large heavy cap on the US stocks right now. So from the S&P 500, it did breach below just the 200 moving average in here, and it's very important from a technical standpoint in here that this eventually turn green pentagon and then break the 200 moving average in here, break the green pentagon, break the 200 moving, and you must break up here and then stay below, then you seem to be bull. Now from the S&P 500, which is technically trading above the 200 moving, as I said before, the difference between Dow, it is heavily more on these value and traditional stock, including interest rate, like the finance and the energy sector. That's why it's traded above the 200-day moving average in here. You could see there's 1 resistance, 2 resistance, and it's just short of 36,000. Now remember, Dow went up to 36 or 38,000. That's about another slightly about another 10%, but it has broke through the 20% mark, and usually when it goes above the 20% mark, you will see a lot of the analysts, especially in the Bloomberg, saying, hey, this market is turning bullish. So it's very important that Dow stay above in here, because right now, as I said before, many of those scenarios that we talked about just now, the war persistent to 20, has been priced into this chart. Unless something comes out that you and me miss out or may not aware, then likelihood this support is likely to be maintained in here. But of course, in between there will be likelihood of the market testing lower or testing higher in here, yet to be seen in here. But it is in what we call a technical bull, because it is trading above the 200-day moving average and staying above in here. But one thing it doesn't look seems to be good is the crossing. You can see right now is the what we call the crossing of the slower moving average to the faster moving average, and that usually points down, just like we have it here. Once it crossed down, You can see, right, the market goes all the way down. And are we seeing that right now in here? Because if we just see this cross down here, like we see here, cross up, cross down, go all the way down. Okay, cross down, go all the way down, and we have seen the cross down in here. It may point to this, and this also is the same thing too on the S&P 500, the cross down. So that's also pointing downwards. Our market not yet. If the Dow and the S&P already cross, we will cross too. Once it cross, you'll see something like that going down in here. So let's see whether you will see that cross. So right now, this technically bull, but the outlook of it for the next 1 or 2 months are looking to be down because of the crossing of the 20 and 40-day moving average in here. It's been very, very accurate, especially on the downside. So keep that in mind. And that's why you can see the Dow Jones is already in red pentagon, and also the S&P is in red pentagon. Now, after having said that, the technical charts, we are seeing the crossing of the moving average, the slow cross down to the low. That seems to be pointing to the bearish side in here. Now, from the S&P PE ratio, right, this is one of the indicator that many people see is how expensive or how cheap it is. When it is very expensive, when it hit around the 38 times PE, right, and usually it's always been a range between 10 to 15, you can see, right, taking the history. But if you take back from year 20 onwards, where the monetary policy is printed out, that is always starting from somewhere around the 15. So right now what I'm saying, that the 19 level that you see above in here is not the cheapest. Of course, if eventually if it does come down to 15, remember I talked about the crossing down, right, of the moving average, then that would present a good avenue for buying those stocks. So right now may not be still a good time to buy, especially on the US side. We are seeing market likely to trend downwards more than upwards. So from a fundamental standpoint, the PE is still not good. Now, this is where I want to point the scenario of the interest rate on the chart that you see. This is from the trading view, where I plot the Fed interest rate chart. That's the purple one, right? Followed by the S&P 500. The S&P 500 is an orange line. Now, you can see from here, in March 2020, okay, in March 2020, where we have the COVID, right? When the COVID came, of course, the market slide down because there will be lack of jobs. There are a lot of closings. Economy have to take a back seat because they have to shut down, right? They have to prevent COVID from India, as such that the Fed chairman, Federal Colin Powell, still then they actually lowered the interest rate. As you can see, once the market dropped, right, interest rate also dropped. But until one point it dropped almost to zero, cannot drop anymore, the market really picks up. And this is where you see a lot of technology stock started to pick up, and that's where they started to run all the way. Of course, even previously they were, but because of the regime of the interest rate, right, which is around the 2.5, the highest, then when you start drop below the 2, it became very, very, now remember, a lot of the technology stocks depends on low interest rate because of the future projection of your tech stocks rely on what we call future cash flows, all right, because a lot of the revenue are future cash flow. But that because, you know, if you look at it like Apple may not be, because they are already profitable and they actually look more like a consumer stock. It's just that demand actually taper off, but somehow the market and the investment community seems to roll them up into the technology stocks, where, you know, usually technology stocks are rolled under what we call future cash flows projection, are projected based on the interest rate. So you can see from here, and then eventually the war started somewhere in February. You can see, right, the war started sometime in February in here. This was July, and that's where inflation picks up. All right, when inflation picks up, Fed began to put increment of interest rate. You can see here was 0 to 0.25, then another 0.5, another 1.5, and it goes on. Now the target right now is to go up to 5 to 5.5%. Now earlier on I shared with you the schedule. I will refresh that schedule again, around 5.25. So he's going to push it up, or he's going to do what we call a slow burn. Push sikit, see the inflation will fall or not. Push sikit, see the food prices will fall or not. But if the food prices don't go, they're going to push up there. But do take note, if they push too much, and then recession comes, okay, for the US side, we all know EU and UK recession is already here because of the high fuel prices. But in US, they have some sort of subsidy in here in place. It's still expensive, but they are much less than compared to US, what they are paying in the terms in here. And if they induce a recession like what happened naturally on the COVID, right, in March 2020, then they will drop interest rate. Right, so you can see from here, as soon as the interest rate drop, right, to zero, when it dropped 0.25, you can see the market really started to move up, and that's what actually the market is going to. It's going through this what we call a slow rate. When is the interest rate going to drop back? Interest go up, yes, it will fall. Then you'll try to pick up a bit in here. But right now on the technical side, it does show we're going to have that moving crossover, cross down in here. And usually that is what we call prophecy by sight. You know, it's like when you see it on the technical, it becomes real in here. All right, because many people believe it does happen in here. So you can see right now 4.5, and Fed will drop the rate if the recession is induced by them. So keep that in mind. So when I talk about this in future, where we have the 5.2 and 5.5 at that level in here, where the interest rate is so expensive, which is actually a cost of transaction, right? It is a cost to do transaction in here, and it's like considered like a tax. Then they're going to drop that interest rate. So it is going to be, if they do, due to the interest rate, right, mild recession maybe sometime in April, May this year in here, then they're gonna drop that interest rate in here. So we have to see this very slow burn in here. So earlier we talked about the interest rate rise earlier on, just to refresh this and recap this. Okay, the completion of the interest rate rise is going to be May. By the time they raise that interest rate, also like you see from previously here, they raised the interest rate so high, right? Market continue to trot along, but when they cut the interest rate, this is where the market, you can see, started to break new high. And very similar is going to be like here too. They raise it up, also good. That means like a rubber band, they pull a bit, right? So they can drop. Then market can spring back up and jump higher. You see my point. Let me repeat. You can see from here, right? When they reach this high here, which is around 2.5%, when they start dropping here, right, then the market from this standpoint, this is S&P, you can see once it drop, they also drop, but subsequently the market just shoots straight up. And the same thing go here. If you're going to plateau, and if there's a recession, they're going to drop it, like what they see here, drop, and then the market is going to shoot back up. It's kind of strange, right, to see actually when recession, or shortly after the announcement that recession is official, right, you see market move up. That's really the bottom is. So I do think that right now we may see the bottom, but of course in shorter term, as I said before, we are seeing the moving average cross down. That means a market may turn southwards in here. But again, these are the so-called the GPS, okay, going forward in here. Now let's talk about the US annual inflation rate. December, we are seeing for the December, because usually for last month, the 12th of December, it is for November. You can see for November it was 7.1. They were expecting for it to go below 7. So for this round, January, right, because of Christmas spending, there were a lot of shortage of workers and things like that. The inflation may not drop a lot, but they are expecting best case for December at 7%, which is very little actually. But you can see the peak was at 9.1. right? And when the market started to drop off, and that's why we see by October, right, the market actually picked back. That's where the low point was. The October time frame was the lower point in here. So next release will be the 12th of January, which is actually 4 days from now. So that's why the market is sort of unsettling, because just waiting for next week for this thing to come out, and then there will be some comment made by the US FOMC, and then there will be some talk. So I just want to get moving. Now, the sector that we want to watch out for is something that I already discussed back in November. All right, remember in November 23rd, if you're in the live Facebook, if not, just catch it again on the YouTube. I've talked about 3 sectors: energy, technology, and financial, at least towards the first quarter of 2023. So if you talk about these 3 sectors until today, are still valid, right? These are the at least for the first half of the year, energy technology. Now, technology will only start to move more after the second half of 2023, after the interest rate been sort of slowed down or taper off. They are likely to delay or cut interest rate. Then you see technology start to move up here. So these stocks, that's something we talk about on the 23rd of November, which is almost give and take about one and a half month ago. And you can see many of the stocks when I discuss on 23rd onwards, it's up. And you can see Dayang and also Hibiscus is up. It's still trading sideways much as it. All prices has fallen a lot in here. So there is what we call general trend for the market. No doubt it can break further down in here, but if it does break the down part, then we just have to wait lah. All right, because right now is the green the KLCI is still green pentagon in here, but look at the particular stocks for the red pentagon for you to decide in here. So for these two stocks, and Frontcan, again, technology stock has taken a beating, but again in the month of December, the market has actually peaked through. For Frontcan on the left hand side, it is still up from the day when we talk about it on the 23rd of November. Of course, 23rd November being on the lower side. And then Inari, of course, Inari is one of the biggest loser. It started very high in January, but it did bottom up sometime in October and now playing a recovery in here. Right now, it is still a red pentagon in here. We just have to be careful whether we are seeing a move downwards from the technology stocks as we've seen before, and will this market go up higher in here? Now, the sectors we want to add on to those existing three stocks, which is the finance, technology, are a bit what we call the defensive stock, which many of you may have came across in here. Now, the defensive stocks or the consumer stocks with low PE and higher ROE are the main theme of our Robie rating of 5, 6 and above. All right, many of you may have played on with our Robie, smart Robie apps, and the same kind of rating also exists in the VSA 360 in here. So some of the characteristics of defensive industry are really not affected by economic fluctuation. No doubt or not, on the COVID, everything was affected. Even food was finding very difficult, and food demand has dropped. Some of the stocks also fall. But right now we are seeing the reopening, and I don't think even government like China has learned that they cannot survive, by closing for 3 years or lockdown. Why? They run out of money. Right? They run out of money. People is not working. And number 3 is high return. And high return, we are talking about ROE. Attract investor because it pays a decent dividend and it can generate earnings. Most important, able to generate earnings in all economic situation in here. So keep that in mind. These are defensive industry in here. So what we have done for year 2023, again, some of our members who have signed up in our recent December, I'm going to showcase to you are the consumer and defensive stocks using the Robie rating 5 and above. So I prepared this already. Now some of these stocks do pay dividend. Take a look at it. I'm not saying that you should buy them or whatever. These are very, very good value. They are really low PE. So let's take a look at the stocks. Now, of course, some of you may want to log in again. Just ask Zach for the password once again to the screen. The reason why I said it, there's actually a password lock. This is for the masterclass members in here. But if you're not in the masterclass member, you can take this note in here. We do hope that you join our masterclass eventually in here and get access of these stocks that I talk about in here. There are actually 9 of them in here. All right, 9 of them in here, and I'm just going to go through, and these were picked on the first day, January 3rd, 2023, and you can just go through. Of course, these are all sorted by highest return, okay, and you can sort by market value too. Okay, the greatest market was 10,000. We try to make it to close as 10K as possible, and you can see these are the returns so far in one day. It is up 0.86% from yesterday. Okay, so this is sort of considering our benchmark going forward. Of course, we are not saying you should buy on 31st January 3rd, and then hold it to 31st December. As I said before, the market's going to be up and down. If you have a certain profit target or whatever case, do take it, as I said before in here, right? Even if you were to hold it, it wouldn't fall that much because some of these are really low PE and very decent and actually have growth in it. So let's take a look at each and one of them. Taking the first one, maybe we sort it out by alphabetical order. The first one is DKSH. So all you gotta do is just click on DKSH. You can see it's rated 6 out of 8, and we do know it's a FADDO. It pays a 2.4% dividend. It's a long-term stock. It's Sharia. It's number 1 in consumer items in here, and it have extraordinary profit in here. So what they do, okay, who we are, they are in the marketing, logistic. Okay, let's see if they have a website. If not, you just click on this one here. It will take you to Dealer Client. So they do a lot of this so-called household water, 33,000 worldwide. They have a lot of products. Let me try to find out what are the products in here. Healthcare, pharmaceutical, consumer product, the fast-moving consumer products in here, food services. So this is why we talk about being marketing, or they have Timex also. I never know that. They're Frito-Lay, or Frito-Lay is that one. Okay, and so these are first one in here. So being the first, and it has right now is about 1.1 to 1.1 in here, and of course. Since then, let's switch to a 6-month chart. It's pretty much moving in a really sideways market in here. You can see moving in the sideways market in here. That's why we say that it's good having a good base. PE is only 6 times in here. Right now there's a safety about 107 in here, so a lot of safety because the PE is pretty low. They don't rate this as high as it is because being a defensive stocks. And of course, you can also look at the 4-year financial in here. You want to see what sort of trend from a daily standpoint. Of course, from a quarterly, since we do hold it from a quarterly standpoint, you can see quarterly, they're actually moving up. Okay, profit margins are pretty low. I would say 0.6, 0.7, 1.33, but you can see quarterly margins are growing in here. Dividend 2.45% in here. PE of 6.45. So that's sort of give it a play of a very low PE stocks. Now if you don't like this one, let's go on to the next one, which is the Plantation. Okay, Plantation again being a proxy to the energy in here, rated 6 out of 8. You can see FADDO also long term. Now there are 9 stocks that we have in here. We may not have time to do it all since I'm sort of confined to the time frame in here, but for those of you who have the masterclass MC in here, you can actually take a look at this one in here. Now this one already exceeded the analyst. You can see 29th of December prices was 158 and started to break out right now in here. So 158 somewhere in here. Well, okay, let's go back to 6 months ago. All right, this is because the higher CPO prices in here. I think it's on a shorter term, you need to start thinking of taking profit, because from the day if you enter near Green Pentagon 180, right now is 190, right? That is almost maybe short of a 10%. Am I correct? In here you can see safety level 59, but if you do want to see whether there's a Red Pentagon to take, it's also okay, right? So right now it is 8.6%. Last indicator was 9th of November in here. Okay, of course, if you were to buy and hold, for Kim Long has been a great performer in here. Let me just make this a bit smaller. If you have bought this and held on from 2016, your stocks is worth 18,000. Okay, not too bad. No, 10,000 with 18,000 in here, and you can see every year make money. Even last year, closed with a 16% return. So far, up 2% for the year. And who knows? Keeping Kim Long may be a good thing. And does it pay a dividend? Yes. 7.45% dividend. I said it before, right? Maybe one strategy would be don't do anything, buy this kind of very stable kind of stocks and just wait until May, then I move back to my technology. That could be one play, or continue to trade the shorter terms, which you can using the intraday alerts, something that we have. That's why VSA 360 is a 360 view of the stocks that you have. All right, let's take one more look in here. Now let me know which are the stocks that you want me to look in here, okay? Magnitech, Mega First, Padini, RC Cap, Cycom, and Sunway. All right, these are just a few because many of these are actually rated very well. Let's take a look at Padini. All right, Padini being a consumer as market reopening, also rated 6 out of 8. It's a long-term stock. FADido, Sharia, right? Apparently it's not in this consumer. We'll take a look at this one here tomorrow. All right, and you can see 1.6. And if you look back in the 6 months chart that we have, Padini is pretty much haven't broken out yet. So it's a nice, stable, range-bound kind of area, especially if you want to buy stocks and sort of hold that dividend. The range-bound is actually the good place to buy, especially when you started to accumulate in here. All right, I know some people like to buy on the pullbacks. That's fine too, or you want to buy on the dips in here. All right, since Green Pentagon 12 days ago only minus 0.3. What do they do? You can look at the company website. Maybe you can just go to corporate. Yeah, you all know that you'll make the baju. You go shopping mall, Bandar Utama, or you go to some of the Aeon malls. You'll see Padini in there, BO, Vinci, Void in here, and they have 1.6 billion last year's sales. Financial year, 4,000 employees, 140 stores in here. They are like a bit like the H&M Malaysia version. PE or 10 times in here. ROE of 23, pay 3% dividend. All right, so again, in the nice base in here, something you just want to be holding on before going further. All right, okay, let's do one last one, which is a utility. Okay, a utility in here, again being a defensive stock. Utility is a defensive stock. 6 out of 8 in here, pay 2% dividend, and an ROE of 17%. All right, ROE is 17%. Let's look at the company website. It doesn't connect in here, and oh, even Mega First, the website is cannot be connect. Okay, that's interesting. All right, maybe they changed the website in here. If you look back in the 6 months, it's still range bound. As I say, we got a lot of stocks that we talk about, right? Hasn't really moved up yet, and that's one of the reasons why we look at these stocks that give us, if the stock really go to move up, then that's a bonus. If not, that's a good support here. You can see lots of very nice support in here, and that's where you want to be it. All right. So due to the short time frame that I have, I'll keep this all for those of you who sign up for members. That's why I said it's always great for the past members in here to enjoy this in here. Make sure if you can't access it, let Zach know, and Zach's going to give you the access tomorrow to get hold of the value stock portfolio where you can actually examine more in here. All right. So I'll just share a couple of stocks just now in here. So what's ahead for the KLCI? So we're going to get down to the 1030 in here. Well, the resistance right now is 1500. We have the double top. All right. The foreign funds are slowly flowing in because due to the Malaysian strengthening, it's ringgit in here. This is again due to the China. The market is still uptrend as a result of the window dressing. Now we all know the US market is turning downwards. We may turn eventually in here, and no surprises if it does turn, and then we'll likely see the market down for a few more weeks before the market turn back up. Market may not be as bearish as you've seen before from the eye of media and analysts. Some of the media and analysts say that recession is here, but as soon as they announce that recession, that's already the lowest point. The market's going to go back up, so keep that in mind. All right, so with that, again, something that we wish to share with the public and also part of our education for 2023 is our 7 tools framework that we use to train our students here. I think I've gone through some of them before. I'm just going to keep it very short tonight. The whole point is to prepare you, give you a plan, give you a market to trade, and continue to monitor your progress. I think that's always been something part of we doing. Just listening, it's not going to be happening. You need to do those work, and if you do those work, you definitely remember. And with the virtual platform that we had, which always been part of bringing out the best in our Trade VSA member for 2023 and 2024 is our onboarding orientation. And we're going to be doing our first second meeting or onboarding orientation next Tuesday. So those of you who are member who's attending, please make sure you do the continued trading and your long-term stocks, and let me know how you go through your thinking and some of the emotion, right? Whether you're a beginner or experiencing here. I think that's also important to see that you're actually able to do this purely from a learning standpoint. Make sure you practice all the trading before you eventually build that as a part of your habit and then master it. That's always been our goal, to record all this and able to move up. So our 3-month Trade VSA membership in here, for those of you who have the highest scores, will definitely win them by heart. And we have some of these older winner in here, started at 50,000 or reached 300 over 1,000 in here, and that's always been something we do. So once you have that practice, especially those of you who are already in our program and doing the right thing using a paper trading, then you ever have some sort of ongoing progress with your coaches. That's me and also Zach in here. Right, having something to watch over you, right? The power of coaching in here. So for tonight, my last word is the year 2023 has likely to form a base. No doubt the shorter term we are seeing the market turning down in here, but market already priced in all the analyst consideration, the recession in here, the downturn in here. First quarter is going to range bound. We're going to cross down the moving average, going to cross back up, test the old support, test the old resistance in here. And newbie, especially if you're a newbie, those of you who have, you must have the right strategy to trade this critical market, something I've shared earlier on here. All right, Robie rating has some good support, especially those shares I've just talked about in here. Check out the MC portfolio to showcase to you for what we have for year 2023, those with Robie rating 6 out and above. All right, and follow the smart money, right? Buy low, especially right now at the support, and sell quickly for small profit. Don't let it run too far. All right, maybe a decent double digit is good enough in here. All right, that's me signing off, co-founder and creator of Pentagon Guider in here from TradeVia. I do hope that you have learned something tonight and able to share it further in our Google review in here. Really appreciate the great review that we'll be getting in. And don't forget, if you want to subscribe for a greater 2023, by all means, check out our plan and pricing in here, giving you the first mover advantage. That's all we have tonight. And next Wednesday, we have a completely new topic and a schedule for the remaining month of January. Don't forget, this is also a festive month for our Chinese friend. As myself, I'm celebrating the Chinese New Year. So I'd like to wish you all a happy New Year 2023, as well as a pre-Chinese New Year in here. And don't forget to share our Telegram chat room for all our stock market information. Be first to know from Trade VSA Trading Idea. Thank you tonight. And if you have any questions, pencil those in. I'll be happy to answer them. Thank you. Bye-bye.